All right. So thank you everyone for joining us so early on a Saturday morning. Uh, this week, what we wanted to talk about was what is the secret sauce to actually flipping risks to rewards? Because we commonly find this phrase in the market, right? That if you have a high risk strategy, then that's going to be your high reward strategy. But what does risk actually mean? And is there a way to turn risk into something that is favorable for us, that gives us better investment outcomes? That's a theme that Harshil and I are going to be exploring in today's webinar. And we're really grateful to have you here. So please do type in whatever questions you have. We'll also keep a significant amount of time to interact and go through like Q&A towards the end of the webinar. So, coming to the first question on our minds, what do we actually mean by risk? And I think this is really well explained by a quote from Howard Marks, where he says that risk means more things can happen than will happen. And what that actually means is that at any point in time, what we expect out of the future is a wide range of things, but what actually happens is a very narrow range of things, right? So when there is a higher level of risk, there are a wider range of outcomes that can occur. And what is favorable is probably just a very narrow segment within that wide range of possibilities. And what actually occurs may be favorable or unfavorable, right? So let's try to visualize what risk is in terms of portfolio returns, right? If we look at how to visualize risk, when we talk about a high risk investment, what you actually mean is that your upside as well as your downside can be much wider. So if you look at a high risk investment, you could go from say -15 to +15. But a lower risk investment would probably contain your returns in a narrower range, right? So you'd be at -5 to maybe +5. And these are just numbers for illustration, but the idea is to look at how um, to visualize risk when you're talking about high risk returns. So what investors tend to see is only the right hand side of this chart, right? Where you see that if I have a high risk return investment, then I'm going to make a much higher risk. I'm going to make a much higher return on my investment, right? So if we're focusing only on the return side and we ignore what's happening uh, on the negative side of the axis, you're going to end up misjudging how much risk you're actually taking. There's another way to also look at high risk investments, which is that high risk investments are those that give you more negative outcomes. And this is something that a lot of us don't understand. Like you can have investment strategies where most of the time you don't make money, and there's a small window in which you can make money. And there are a lot of these asymmetric opportunities, and usually what happens is that investors tend to chase performance. So if you're looking at an asymmetric opportunity and you're chasing performance, then you're actually just taking on risk without really taking on return. So moving on to the next part of our presentation, which is now that we've understood a little bit about how risk works and what it looks like, how do we actually get to flipping risks to rewards? And I'd like to show you one of our favorite charts, which is the asset quilt, and Mint publishes this every year. And it's a very interesting chart because it shows us that three important lessons, right? That one, nothing stays at the top forever. So whatever you think is a winning strategy, cycles change, markets change, and winners can become losers as well as losers can become winners. The second most important lesson is that almost 50% of the time, you have years where all assets do well, right? Which means that you don't actually have to think about leaving one particular asset class out or believing that something doesn't work for you. And the last thing, and probably the most important lesson, is that there are no years where all asset classes fail you, right? Which means that this gives us the sort of hint and framework that, yeah, there are ways to make returns. Now we're just going to quickly show you what happened between 2016 and 2019, right? So if I looked at the returns that happened in this 4-year period, your large caps stocks had a compounded annual growth rate of 11.65%. Your mid caps didn't do that well. They were about 7.4%. And your small caps had a very measly sort of return at 3% compounded. Whereas you had alternate asset classes like government securities that actually compounded at 9% in that period. And you had global investments at 14%, as well as something that like gold, which was giving you about 11.5%. Right. So in this time frame, if I look at how long it would have taken to double money if I had invested in these asset classes, for large caps, it was about for large cap as well as gold, it would have been about 6.5 years. For global investments, it would have been less at 5 years. And then you had your government securities and your mid caps where it could have been anywhere between 8 to 10 years. But your small caps would have taken about 23 years if you were growing at that pace to compound or to double your money, right? So now we're going to do a quick poll, which is to ask you which investment would you have picked in 2020 if you had to make a decision based on this knowledge. You can just quickly type in whatever you feel in the chat and we'll take a look at that. You can also tell us the thought process behind why you've picked something as well. Okay, that's a good answer. All right. Fair enough. I did not think about that. Okay, so it's sort of, so let's look at what actually happened in the next 4 years, that is 2020, 2021, 2022, and 2023, right? If we looked at how large caps performed in the first part, that was about 11.5% compounded. In 2020 to 2023, you would have got about 14% compounded, right? With mid caps, you went from 7% to about 23%. And with small caps, that jump was even more pronounced, where you went from 3% compounded to about 30% compounded, right? Whereas if you had picked your safer investment like government securities, you would have gone from 9% to maybe 6%. And 2 of those years were relatively weak returns on government securities, right? Similarly, if we looked at global, you had more or less the same return in this period, and the same for gold. So the thing is, our expectations of how assets perform in one period versus how they're going to perform in another period actually need to change. And if we look at how Mr. Shiva voted, he said he was looking at option B because earnings were just picking up. And obviously, none of us knew that COVID would happen, right, at the start of the year. We didn't anticipate that something like that would happen. And of course, there was some market impact when the pandemic first hit, but you saw that markets recovered by June. There was a lot of exuberance even before the economy opened up. You had the markets reacting to more positive signals. Now, what this goes to teach us is that one, in each cycle, assets can actually perform in very different ways. And we need to anticipate that to understand how or what is favorable in which asset class at what point in time, right? So let's just quickly take a look at what happened in small caps. Why was it the same investment that you were looking at between 2016 and 2019 did not so well, and then you had a fantastic run for 4 years after that? So if we look at what happened, so 2017 was like the end of the bull market in small caps, right? So you had a massive run up in small caps for the three odd years before that. And so when you have a lot of returns front loaded and then you have a couple of years of bad returns, right? Then that if you start investing at this point, then even if you make good returns, because of the drawdowns in the following years, your returns will sort of average out. right? So if you have three very mediocre years and one fantastic year, it doesn't really make up for it, especially if your fantastic year comes early in the cycle. So the same thing if we look at what happened in small caps between 2020 and 2023, you had two really good years. You had 1 year of drawdown, and then you had another fantastic year. So this kind of return obviously will give you a much more positive outcome at the end of this journey, right? And we could go back and look at different assets across the spectrum and look at how these returns actually change over a period of time. So if I take the 6 year period between 2012 and 2017, gold had a very flat return. There was almost no return for an investor who came in 2012. And that was again because until 2012, gold had a very good run, right? Then if we come at the next cycle between 2018 and 2023, gold has compounded at 12%, right? That's a pretty great return because over 6 years, you would have actually doubled your investment in this, you would have doubled your money in this investment. So, how do we decode these different outcomes? We need to look at this framework and try to understand that when assets are expensive, there is a lot of interest in them because by then a lot of people already concur that this is a good investment. A lot of people are willing to buy. The demand is much higher. And that actually makes the asset class more expensive and it elevates the kind of risk that you're taking, right? So starting your investment when there's a higher level of risk means that you need to be prepared for a lower level of reward, right? If on the other hand you start your investment as an asset class becomes cheap, then you're just setting yourself up for higher rewards, right? So if we chase performance, that's what we can learn from this. If we chase performance, we're also chasing risk, right? And the outcomes are not going to be as favorable as we would expect based on what has happened so far. So we need to follow a slightly more different or more nuanced approach when it comes to selecting asset classes. And we need to look at what are the positive signals and what are the negative signals and whether it is the right time to take a decision or an allocation into that particular asset class. So let's look at what you see versus what you get, right? So if the perceived risk is high, that is, if overall sentiment about a particular asset class is very high, then the actual risk could be quite low because everything that can go wrong is already factored in, which essentially means that the outcomes from making an investment decision are going to be really good. If the perceived risk is high and the actual risk is high, you're not going to make a really great outcome, right? Uh, Similarly, if the perceived risk is low and the actual risk is high, which is what tends to happen when you crowd around performance or you chase the popular themes and asset classes in the market, then your outcome can also be poor in that situation. And sometimes we need to recalibrate what is happening in the markets and understand that maybe we should prepare for modest outcomes when we're not sure about where the perceived and actual risk levels are. So if you think that your perceived risk is low and your actual risk is low, so sometimes it makes sense to look at an asset class like fixed income where this is easy to judge, right? And you with a modest outcome, you're actually going to last the cycle and you may be able to rotate into better asset classes in the future. And with this, let's look at a quick framework of how we can flip risks to reward, right? So, how do we know that a particular space is risky? We need to be very conscious of valuations. We need to understand, okay, historically, what has this been worth? Are there any structural changes that can allow me to value this at a higher level than historic levels or not? And then we can decide whether there is more risk or more reward in that space. The second element of the framework is to stay away from the crowd. If you hear more and more people talking about something, it means that the perceived risk is low and the actual risk is rising in that space, right? And the third way of flipping risks to rewards is to understand that good things come to those who wait. So if we're able to stay a cycle, right, then or longer than a cycle within a particular theme, then you're going to be okay even if you start at the wrong point. And lastly, a little bit of everything works. This brings us back to our first lesson from the quilt, which was, or the last lesson from the quilt, which was that there are no years where everything fails you, right? So if you want to consistently compound and consistently create wealth across cycles, then following this approach of having a little bit of everything is a fantastic way to protect your returns and to protect yourself from the market risks that may be there. And with this, I'll hand over to Harshil, who will be taking you through the next part.
Hi, thanks, Samyuktha. So does this really work? Right, let's actually see how you can uh, flip your risk to reward, and this is something that we did in Sphere. So you look at this, right? Everybody is sort of waiting in the sideline. There is a lot of crowding that has happened, and usually this happens even in the markets. If you look at what's been happening in small and mid cap, there is a lot of crowding that takes place. Right now, also there is so much of crowding that is there. In the entire of last year, 45,000 odd crores has just gone into small and mid cap funds. Right. So you know that there is only a subset of these companies that the mutual fund is allowed to invest in, and therefore they will be only chasing those sort of 250 names. Right. So this is how you. So I saw this question of how do you see risk? Like, isn't it subjective? See, when it comes to risk, all you need to understand is that when you're going contrarian, you will always have these sort of questions to say, am I doing the right thing? Right? Is the risk high or is the risk low right now? Knowing very well that the last couple of years have been really, really bad for me, right? Or have been bad for the entire industry, right? So you have to look at it from a relative perspective to see uh, how is it that risk is sort of playing out, how is it that risk sort of played out in that particular era, and how is risk framing out to be right now, right? Because the numbers only give you a certain picture, but only if you live that particular scenario, only if you're there in that particular scenario, will you know how is it that risks are playing out, right? So for example, during COVID, right, there was a slide on COVID also. During COVID, there were many themes that did extremely well. There were many ideas that were considered extremely risky, right? But it suddenly became less risky because earnings started to kick in. Right? So the minute earnings started to kick in is where you saw that the risks started to go down. Right. So I'll move on. If you can just move on to the next slide. Right. So now you look at public sector banks. Now, public sector banks, in fact, public sector as an entire narrative was considered to be extremely risky. Right. Now, during 2015 to 2020, the profit that public sector entities were able to generate, right, these PSBs, right, they were down 35%. So the profit had gone down by 35%. Right. But what happened in the subsequent years after 2020 was that the earnings started to kick in so high and everything started to play out extremely fast, where the profit pool, because of that low base, started to go up. Right. But what actually happened during that entire period of time was that they were losing deposit share. Right. We had that period during 2000 to 2010 where public sector were considered to be monopoly businesses. They are still monopoly businesses, but that narrative started to change. So when the narrative started to change, you saw that the valuation started to get re-rated. Right. People started pulling their money out of these sort of public sector entities and go towards private. So you got this narrative saying that public sector banks are losing deposit share, right? Naturally, if a public sector bank loses deposit share, then they can't go out and start giving out loans, right? So this is what happened during that entire phase where they were losing market share. Now, that doesn't mean that they were not getting deposits, right? They were getting deposits, but they were losing out on that market share to private banks, right? So naturally, as you keep getting more deposits, private banks are getting more deposits. We had an entire period of credit growth, credit driven growth during 17, 18, 19, and 20. And you saw private banks do extremely well, right? Private banks were one of the best performers in 2018, right? And that is, one way where you know that yes, risk is ballooning up when it comes to valuation, when it comes to sentiment, not in terms of fundamentals. Right. But the fundamentals here had been deteriorating, and the sentiment had gone way beyond those sort of fundamentals. So if you look at these numbers in 17, 18, and 19, you see that loans in for the public banks have been very, very low, but private banks have been steady. But after 2020, what happened? It was completely flipped. Right? You saw periods where public banks did extremely well, right? Because they were already operating on a low base, and then that's the earnings started to kick in for them later on. So if you move on to the next slide, here you go. This was the slide that I was talking to you about. Now, 13, 14, 15, 16, and 17, right? 13, 14, and 15, they were good years. But what happened after 15, right? Your top 6 public sector banks' earnings started to deteriorate very badly. We had a slowdown, right? And then the IL&FS crisis happened. Everything sort of happened where the banks were forced to sort of increase their provisions to handle all the non-performing assets, right? And then naturally that doesn't hit the bottom line, right? So during this phase, what happened is because you're earning less, your perceived risk becomes much more higher, right? In that, so when you see a proper PE, right, you see only when the earnings go up, right, will the PE ratio look low. But what happened in this case is that because the earnings went down, the price looked extremely, so the PE ratio looked extremely high, right? So they were considered to be expensive, right? Because the narrative is there. They are considered to be very expensive. And second, they were losing out on market share. Third, they were having too many regulatory issues that were going on. And fourth, they were losing out on profit share. Right. Now, this is a period where you have to take that sort of contra call where you say, no, this is not a risk. This is just a perceived risk that's there. Right? There are inherent strengths that are there in this entire space. They are one of the largest profit pools in the banking space itself. They have the largest deposit share also in the banking space. Right. So it's just a regulatory change that has to happen. It's just that the economic environment right now is not conducive. And usually when the economic environment is not conducive, usually public sector banks, public sector entities, they don't perform that compared to private. They do not perform that well. Right. So things that are in your favor is that one, the entire all of the issues are factored in. Second, that perceived valuation is high, but inherently it is extremely cheap, right? And third, a slight change also in perception, a slight support that comes from the government in terms of regulation, some sort of a recapitalization. And that's what happened in 19, 20, and 21, where they were recapitalized, right? Any small trigger also can change that for these entire for that entire theme or for that entire industry, right? And that is what happened. So if you see 20, 21, 22, and 23, your entire earnings started to go up, and you saw significant re-rating happening after that. If you can go to the next slide, right? So if you look at this, public sector banks' PAT contribution to the total banking sector has increased since FY15. That FY15 was the low. Right, if you see 63 became 48, and then after that, because they were going through so much of loss, right, you can't consider them as sort of bad, right? And GNPA ratios, that is your gross NPA, you cannot look at net, but gross is very, very high, right? Gross numbers were extremely high during that entire 15, 16, 17 cycle. So you see a story playing out, right? Things are going extremely against them. They are losing out on market share. They are losing out on profit pool, right? Naturally, they are looking very expensive because of negativity that's there. You see a lot of call in terms of you see a lot of sell calls that take place. The entire analyst community will sort of go bearish on this entire space. So that means that all the weaker hands are out. Everybody is out, right? Nobody wants to look at this space, right? but inherent strengths are there obviously in it, because they happen to be a very large pool of the deposit share, right? So all that has to take place are certain triggers, right? Fundamental issues are already coming off because the government is supporting them. So naturally, it's just delayed gratification. It's just some amount of time where things can change, right? It might take 2 years, it might take 3 years. Our assumption was that it might take 1.5 years for things to play out as expected after COVID. And that's what exactly happened. So it took 2 years, right? After 2 years, that is in 22, was when the market started to re-rate these companies, the entire public sector packed, and banks happened to be the forefront runner first. And then came up all the other entities that are core to GDP growth, right? You have to see, because they are so core to the economy, right? You can't have them trading at these levels. Naturally, there is some change that has to take place. And that is why you have to look at risk only from that angle, right? Right. So PSU bank earnings to complete total Nifties today have reached a decadal high. But if you look at 13, they've been deteriorating. Right. If you look at public sector bank weight in the Nifty itself, that is the Nifty 50, these are all signs where you can look at, yes, they've been losing out a lot in terms of profit share. Investors have pulled out a lot of money. Domestic institutions have pulled out a lot of money, and that's why you see the weight also starting to come off. Right? It's all playing out as a very, very nice sort of narrative. But is it the actual story? No, it was not the actual story even at that point in time. So we were able to buy in at cheaper levels. So your only risk has to be, after seeing all of this that's taking place for you, validate what is the story, what is the narrative, and then try to take a call when it comes to investing in these names, right? You have to come in with a lot of conviction, because you're going completely contrarian against the entire market, right? And that's what Sphere is able to do, because we were able to be contrarian, and we were able to, since they were cheap, we were able to buy them at extremely cheap valuations. So naturally, it worked out well. Right? So what is it that we were liking? The negative coverage was one thing that was forefront for us, that we were liking a lot. That all the negatives were already factored in, everything was done. Yet there was negative sentiment that was taking place. Because of negative sentiments that were taking place, naturally they were trading at extremely cheap valuations. Both you have to look at more from a PB ratio. But if you look at ROEs and ROAs, ROAs were, because they had to make a lot of provisions, that number also started to come up, right? But that's an anomaly, right? That is the support that has been given to you by the government. So regulatory changes started to kick in, like all the regulatory support started to kick in, and things started to take place slowly. It was not supposed to be very fast. It just took place, and COVID jumpstart this entire thing. So during COVID also, what happened was, these banks were not having a lot of issue. Why they were not having a lot of issue? Because in the last 2 years they were being recapitalized, and it was not only public banks. It was the entire banking pact, that in the entire world. If you look at US today, US banking system is going through its worst crisis in history, right? But Indian banks did not go through any sort of crisis, because we had already been recapitalized the last 2 years before COVID, right? So we took that basket approach of investing in particular segments of the banking space. And what we found cheap was where we started to dial up on that particular basket. So this is the approach that we take when it comes to investing in contrarian themes where we have high conviction. We look at it from a basket approach, and we make sure that we are buying in completely cheap. Right? We are buying in. We understand that because the sentiment is negative, naturally it takes a lot of conviction to go into these places, right? And taking that call to understand whether they are inherently cheap or not. See, certain industries might be cheap for an extremely long period of time, because there is no earnings growth that come in, right? So that doesn't come up in our framework to say, yes, these are names that we should be doing. No, there are some industries in which there is very low growth. There is no growth also for some matter, and their valuations to be cheap are justified, because profit pool does not go up. Market share in profit pools also do not go up. Right? The industry sees a deep slowdown. There is a long shift between unorganized to organized, right? And some industries sort of deserve that sort of cheap valuation. That doesn't mean that they are inherently cheap. Only when the earnings growth sort of come in, That's when you know that yes, these are industries that are cheap. These are industries where a contrarian call can be currently made. Right? So we take a basket approach when it comes to investing in such teams, and our framework is to understand how cheap is actually cheap for us to take a very big call. Right? So how did we go out and do that? So if you look at so this is how we have been playing out public sector banks. This was not a very small position. Right? This was one of our largest positions in the fund. Right. This was somewhere around 10 to 12% of the entire fund since inception. Right now, we have the liberty to have this conversation with you because we don't have any sort of exposure. But usually, when you take a contrarian call and when you take a high conviction call in particular themes, where you have to wait for earnings to start coming in, where you have to look at sentiment, right? It takes us 1.5, 2 years for us to build a proper position in the entire space. So for us, it took us 1.5 years where we were continuously buying. Right? We had one exit because markets were heating up. It was not that the public banks were heating up. It was that the markets were heating up back then. And we were expecting that there are some macro issues to come in globally. So we took a broad-based call that we should be reducing our position, not by virtue of negative view on the entire theme of the sector, but just by view of broad-based correction. But our buying did not stop. Our buying did not stop for a good 1.5 years. And as and when things started to play out, was when we were able to have a very fruitful outcome. Right. And that fruitful outcome was only able to happen because we were holding it, for a long period of time. Right. And this is not just 21. This is back then also, but since 21 was when Sphere was started, we are giving you 21, but these go way back from 2019 and 2020 as well, back in the RI service. Right. So usually it takes us 1.5 years to sort of buy into a particular theme, buy into a particular contrarian idea, and then hold it as things start to play out. Right. Usually it takes, say, 4.5 to 5 years, right? So deep value sectors like this take 4.5, 5 years. Some actually play out within 3 years or 4 years as well. But 5 to 7 years is what our entire assumption is on when we are looking to build positions in certain contrarian ideas as well. Right. So this is how we do things in Sphere. Right. So this is just a testimonial of a client where she was one of the initial supporters of Sphere, and for this particular, so every portfolio that we build is completely different, which means that the processes that we run for each individual client are extremely strong. Why do we do this? Is because we understand that risks and rewards in every market keep changing. Something that was a winner in the previous cycle will not be a winner in the next cycle. And Samyuktha rightly showed that to you as well with small caps and gold. So it depends on when the investor comes on board in that one particular cycle. Say, for example, if you come on board in this particular month, or the next month as well, your portfolio will be completely different from that had been built back in 2021, because the opportunities were different then. Some ideas would have played out, but some might not have been playing out, right? So you would have more of something that did not play out and less of something that played out, and none of something that played out for us, both sentiment wise, both fundamental wise, everything, right? Only when it comes back into valuation radar is when you will see us having to go out and support that data. But essentially, we do keep portfolios for investors completely different, and they are managed also completely different based on that opportunity, right? So this is a product that is meant for people who want to save regularly, which means that you can do SIP also in this particular product, right? Because opportunities are different. As you keep contributing more, you will have more space to participate in new opportunities and existing opportunities. So by virtue of your participation itself, your portfolio will look completely different. Right. So that's how we are running things here in Sphere. in terms of performance, we've been able to outperform. So we usually want you to see from a 5 to 7 year perspective, but since we have been running this product for 3 odd years, just from that comparison alone, we have been, since we are a multi-asset, dynamic multi-asset product, we've been able to outperform your multi-asset mutual fund as well as your pure equity flexi cap fund as well over the 2 years that we have been running the product for. And in fact, this is December data, but your drawdown, so our worst particular sort of performance, that is during the market crash in June, was 11%, and the Nifty had fallen down by 16%. So we are able to manage risk extremely well. In fact, during those periods when we were sitting on some bit of cash, where we were able to deploy it and grab in ideas that were extremely cheap with high position size. So we were able to buy more of something that was extremely cheap, and that worked out very well. And that's what was seen in the performance bureau. So we are able to dynamically take advantage of any market fall that comes, because we have no cap on a particular asset class. We can go from 0 to 100 in equity, in debt, in precious metals, in cash. Within equity, we can take, an ETF call or a mutual fund call or a global call as well. Right. So there is no cap on anything. So because we were skeptical of how valuations were playing out during that entire place, our cash allocation was significantly higher, and we were able to take advantage of that particular scenario when that came in. So that's why you see that having lesser drawdowns and having more risk actually works. That's how we've been able to flip that particular risk to reward. This is just in terms of our performance in January, but what you should see is our asset allocation split. That's what I want you to see, right? These performance numbers are in 1 year, 2 years. Yes, they've been high, but what you need to see is the asset allocation split. So today's asset allocation split is 81% in equity. This is at a fund level, 9% on the precious metal side. We don't have a lot of cash, but client level wise, we do have cash, because we are not deploying everything on day one. Right? We take time, like I said, to deploy money. Right now, our deployment has to be somewhere around 45 to 50%. That's what is going into the current market. Nothing else is going, right? And the newer ideas that we're planning and looking to add into, because we are multi-asset, because we don't have that performance pressure and that pressure to invest on the equity side, we are able to take a debt call. So today, what you're seeing at a fund level, 2% is debt call, but client individual level, you will have debt more than 15 to 16%, right? On an overall level, when you include a little bit of cash as well, right? And global happens to be 7%. That as a fund level and investor level happens to be the same, right? So all of this is fund level, but in the last 3 months, we've been able to add more debt because the opportunity right now is coming up more on the debt side. One thing that you did not see on the quilt, which I don't think that Samyuktha also, and Samyuktha is our principal of fixed income, highlighted that so you saw that opportunity from 2010 to 2014 on the debt side, but 18, 19, 20, after there on, debt did not come out on top, right? So there are content in place there are contrarian ideas that are available to investors right now, and Sphere is able to take advantage of these contrarian ideas because we don't have that cap. Right? We have that opportunity to take down on wherever that opportunity comes, wherever we are able to see where we can flip that risk to a reward. That's where we are starting to build positions there. Right? And we take time to build. So it's not that it's just 3% in one shot and then leave. No, we have that option to go from 3 to 5, 5 to 10, 10 to 12, 10 to 15 as well. There's no cap on how much we have to invest also in a particular idea or a particular theme. Okay. So I think now, so this is just the terms of investment. Since it's a PMS, you have to put in 50 lakhs to start off with, and then you can top it off with whatever bonus you get. But SIP is the best sort of model for you to look at, because these are investment vehicles that are meant for retirement, and we are only looking at it from a retirement perspective. So SIP works for you very, very well. Maybe in the next couple of presentations also, since we start aging as a portfolio, we will be able to show you how our SIP numbers also come out to be. But give us some time. Let the portfolio age. Let some certain ideas play out that are SIP oriented, and then you will see that number starting to come in. Okay. We have a fixed fee model of 1.5%, which means that on your portfolio, it's low at 1.5%. It's very similar to that of a direct mutual fund, and there is no exit load, right? So your investment horizon should be somewhere around 5 to 7%, right? Our assumption for return, since we are multi-asset and since we are dynamic, right now we've had more allocation to equity. That's why you're seeing that the returns are extremely high. But over a long period of time, you should expect average inflation plus 5 to 7% up. That's what you should be expecting from this particular product. So this is just our team. If you see, all of us are there on the entire strategy side. We have other products in our bouquet, that is Solitaire, which is a flexi cap fund. True Blue, which is a pure large cap fund, is a high quality large cap fund. Vriddhi is our private equity style small cap fund. Right? And there comes Sphere. We also have another product just that is meant for non-resident Indians, and you will keep getting notifications of events that are webinars that are taking place for that particular product. But that particular product is called Neo. So now we can open the floor for Q&A.
So I think we had one question on how do you know what the actual risk is, and I think whether there's a way to quantify this. Harshil has walked us through some points. So from a very, if you want a quantitative approach, then I think our framework always rests on valuation. So we look at what the historic valuations are, and then if you look at that fundamental trend and see whether how much you've deviated from the median, right, or the mean, then you know that eventually things will come back to normal. The only question is like how long will it take? Sometimes it can happen in 2 years, sometimes it can happen in 5 years. So as long as you're confident of a trend reversal, then you know that the actual risk is lower in that particular theme. If you're approaching it from, let's say you're deviating downward from the mean, if you're deviating upward from the mean, again, that can sustain for a really long time, right? You don't know. So the only thing that you will not know when you're looking at actual risk is how long it will take for that risk to materialize and for other people to judge it. But from a qualitative perspective, we have a lot of behavioral indicators. So even if you're just networking with people and talking to them about where they're investing, what they're doing, you can get a sense of where the herd is, where the crowd is moving. What are some of the red flags that people are just willing to ignore, right? So in many cycles, we've seen different things happen. So I can tell you in 2017, um, we would interact with a lot of conservative investors who were only used to having fixed deposits, right? And they would tell us that they have this one mutual fund or two mutual fund schemes where they're getting a monthly payout of 1%, right? And these are people who had never been in the equity markets before, who were very risk averse, who had only experienced this fixed, stable return from a fixed deposit, who are willing to put all of their money in the market. Now, that's a very clear behavioral indicator that people are not understanding what risk is. So the perceived risk at that point is very low. So if you see people moving well out of their uh, risk profile or risk comfort zones, then you know that the perceived risk is very low. Similarly, if you know somebody who's so what we saw happen in that cycle was 2017, 2018, people were pumping money into small caps, right? Even the most aggressive investors, they would come and tell us, no, no, I have a very long investment horizon. I'm willing to be invested for 10 years, 15 years. So people who otherwise are saying that, no, I want to know what my 3 year return is, right? I want to know that in the next 2 years, I will get this return. Or and then they're saying, no, I'm fine with this level of risk. I'm fine waiting for 10 years. That again tells you that perceived risk is low, right? And then you'll see that their behavior changes as the actual risk starts coming down and the worst of it is over. So I think that qualitative framework of observing how people are behaving, what kind of decisions they're making at different points in the market cycle, can actually give you an indication of this um, balance between the perceived and the actual risk. So obviously, if there is low risk in the investment, but other people think that there's high risk, it's the valuation is going to go down, right? And that's how we interpret that table. If other people perceive high risk, but the actual risk is low, then the opportunity for returns is much higher. And if you keep doing the different variations, then you can sort of judge what is going to happen based on the perceived and actual levels of risk. So, what is the idea and opportunity right now? I think we are trying to play it as safe as possible. So, if you again look at our asset allocation split and some of the things that we have said, we are quite focused on fixed income in the current year. We do think that there are a lot of opportunities there, and we are okay with a modest outcome as long as we have managed risk well for all of our investors. If there are any other questions, please do type them into the chat box. We'll be happy to take it. Otherwise, I think Harshil is going to be doing another webinar in 10-15 minutes. So we can wrap up a little bit earlier if there are no more questions. Harshil's webinar is for M2W, I think, on PSUs. Harshil, you want to talk about that?
Yeah, so since we covered public sector banks here, and public sector funds have done extremely well, I thought that I should be covering some bit of data on public sector funds on the Milestones to Wealth platform for investors to know if yes, is it a good time, is it not a good time, what is it that they should know when they're looking to invest in themes like public sector.
All right. I don't think there are any other questions. So thank you everyone for joining us today. It's been a pleasure having this conversation with you. We hope you found this webinar insightful. And if you want to talk to us at any point, these are our coordinates and you can get in touch and we will get back to you on whatever you need.
So I think there's a question on, is there growth still in the PSU theme for the long term? Do join into that webinar. I've put out a good amount of data. And then you will know you'll be able to judge, right? You will be able to flip that risk to a particular reward, right? So do join in. I think you had already gotten that the registration link online. So looking forward to meet you in that particular webinar. Thank you so much, guys, for joining in. Have a great day ahead. Thank you.